In order to have a stock market crash, you need a spark. You can have markets go up for what seems like forever, defy not just the fundamentals but gravity itself. There comes a time when a circuit breaker pops and everything changes. The question on everyone's mind is, what is that spark? You came here for the truth, so let me unveil that for you. This is the topic for today. I'm going to be covering a lot of information, looking at what we could see, what we've been seeing, and how this will all play out. It's very difficult to be able to predict the future, of course, but we need to see where there are excesses, where there is too much, and simply where there's not enough. A lot of investors are wondering, where do I put my money? What is fundamentally a good decision today? And what will it look like tomorrow? Now, I want to get into this information. I've got charts, I've got articles. Let's get into it right away. There was a detailed article right here. Stock rally poses question, when does a bull become a bubble? And clearly the market has been rising tremendous gains throughout this period. And there has been this real question, at what point does it end? A lot of those in the industry have suggested there's absolutely nothing stopping this, and it will continue on for the foreseeable future. Why? Because of course the quantitative easing, the stimulus measures, and so on. I talked about this a lot of times. If you look at what I think I have it pulled up here, Goldman Sachs basically saying there is no bubble, you don't have to worry about it. So even that propaganda is coming out there as they push this on every investor's mind, not just the high up, but of course all the way down the line. This was the one I was talking about. You could see on Monday, even Goldman Sachs research note titled Bubble Puzzle, a guide to bubbles and why we are not in one. It acknowledged that some indicators of retail trading activity were worrying. It mentioned that the surging levels of daily trading in stocks and increased buying of tiny amounts of stock options by individuals. But there's more to mention here. I just love to see those big institutions and what they have to say, and they try to calm investors' minds at all times. Of course, as we saw throughout the financial crisis, through the tech boom, through all the booms and busts, in fact, you see that these big companies and the central bankers and everybody, they're all complicit. They're all working together, and you got to realize that. They're not allowed to actually publish information that would be very telling and worrying for the public. They're only allowed to say certain things. And you look at it, for example, 2007, 2008, 2009, 2010, the whole way through, most of these individuals working for these institutions and the central bankers all said there is no problem. And that's right through the entire cycle. And yet you've got people still today who haven't recovered. So they're going to have a different opinion than Ben Bernanke did during that period, than Jerome Powell has right now, a multimillionaire telling people that when they print money, it helps the little guy. I mean, it's pretty much spitting in your face, and a lot of people should be more upset than they are, not, at their local, government official or something. We're talking about the central bankers and their role that they play in this. Okay. This is part of this that was written up here, Boom and Bust, A Global History of Financial Bubbles. To make them, he said, you need 3 ingredients, and this is the point here, plus a spark. The ingredients are ease of trading, access to credit, and mass speculation. 1, 2, and 3. All of which are in ready supply right now. The spark, he said, is the unknown factor. It could be a change in government policy, like the push to supercharge home ownership in the 1990s and 2000s, or a major technological development, the way electrification contributed to a boom in the 1920s. So the conditions, Mr. Turner said, are all here. John D. Turner, okay? Now, it doesn't matter who said that. All we need to see here is that everything is in play. The simple matter of fact is that there hasn't been a spark yet. And even if you look at what happened March 2020, that's not necessarily a spark that could send everything down. It could be, but it wasn't enough, clearly, as we move through and the stimulus being pumped in. Now, I'm talking about the stock market itself. the economy. The economy is facing major setbacks, and the growth for the foreseeable future is going to be slower for the average person. If you look at wages, I'll show you that in a second, that is not going to be where it was previously. There's so much here that they refuse to acknowledge, and the government providing 27% of income is a very frightening thing to keep this all going when you've got 70% of the economy relying on the consumer. Big problems. More propaganda here out of CNBC. This chart shows why investors should never try to time the stock market. Now, I do agree with that in a sense. If you're trying to get in and get out, the majority of people, they do not win. Okay, you can, it's possible, but the majority of people do not win. Investors should avoid the impulse to time the market. Looking at data going back to 1930, they found out that if an investor sat out on the S&P 500's 10 best days per decade, total returns would be significantly lower than the return for investors who waited it out. Okay, so basically what they're saying is don't panic sell, don't do anything except buy and hold. That's what they want you to do. And that is, obviously good for them and the big companies and all of those who make money on the trades and so on. This particularly benefits those with the mutual funds and different actively managed funds. But we see that changing over time. Still, the rhetoric will continue. This is the chart that corresponds to that. The difficulties of trying to time the market. Bank of America looked at the impact of the missing the market's best and worst days each decade. And you can see along here, decade 2020, price return 18%, excluding the worst 10 days per decade, 125%, and then excluding the best 10 days, that was the worst 10 days per decade, that's 125. The best 10 days per decade, minus 33%. And then it goes on, okay? All you're trying to say here is that if you would have just stayed in, you would have made your money over time. But, it's a little bit misleading. And this is the point I want to make. Did you put your first dollar? If you're the one saying, yes, that's what I just hold. I buy and hold. I buy and hold. Did you initially put your money in 1930 and then you sold it off in 2020? Okay? Probably most people would say no. Okay? And did you buy in 1931, in 1932, in 1933, and so on? Did you buy each and every year and, the months within that year and the days within that year? Yes. Okay. So now there's much more variance to talk about. They pick these arbitrary numbers all the time when they show this type of information, trying to make it sensible, to simply put your money in, keep it there. When you're 65, you can retire and live happy and everything's going to be so fantastic. But unfortunately, it doesn't work like that. Okay, there's so many more aspects to that. And that's really where I believe they are trying to intentionally mislead. Leap in gas prices puts $3 a gallon in sight. And I could have sworn, if I'm not mistaken, this was already at $4 in some places in the US. In Europe, you look at it, it's much higher than that, obviously. And when you price it in liters and you look at it, quite frankly, what we're seeing here is just one of so many different commodities that have been rising in price. And the way I look at this is that it impacts people and their ability to spend on other things. The higher the gas prices are, the higher their electricity prices are, the less money they have to spend to go out and buy things that otherwise they don't necessarily need. Maybe they go to restaurants and the movie theaters, not that those are really open today in many places, but the whole point is to get that money in the economy. Out of the BLS, you can see the real earnings summary, and all I wanted to note here was that because of an increase in the CPI-U, this had declined. And there's been a consistent trend. You have to measure your real earnings, and that factors in inflation. The heavier the inflation gets, the worse it is on you for your earnings. That's why this is a terrible problem coming forward, especially because you had people who were getting less salary, less hours. At the same time you've got inflation, it's eating them from both directions. A $60 billion US stimulus windfall is heading China's way. A rise in US spending will boost Chinese exports and GDP. Trade boom could add to inflation pressure and US tensions. Further along in the article, they got some more information. Check it out. Export boom continues. Chinese shipments set to rise again this year. You can see forecast, the blue line there for total exports, and it's going up to almost as much as $3 trillion. And you look at it comparing the whole world except for the US, and then as well as the US in there with the pink. I just find it interesting to see how much that China exports. They are truly the manufacturer, the engine of the world. And that's the way it was set up many decades ago. And there has been somewhat of a change. Many factories started to move out production into Vietnam and others. But if you see the way that this machine works, it is unbelievable. Anybody who has had to deal with moving stuff out of China, you will note how very, very, it's a well-oiled machine. Essentially, they've got the whole thing in play. And why? Because they've been doing it for so many decades. This was intentional all from the beginning. This whole system was set up like this, and of course that's not going to change anytime soon. The tensions here, they might have tariffs and so on, but without China and their ability to export, the whole world has to pay much, much, much higher prices. We're talking about significant increases, and inflation, additional inflation, is not what people need right now, that's for sure. In any illusion, you want to be able to distract the viewer so that you can, do that sleight of hand. You want to trick them, and that's what happens here whenever we talk about people like Janet Yellen. Supposedly, check this out. Yellen supports banks' share buybacks. Senator Warren wants BlackRock designated as too big to fail. Okay, right. Just everybody calm down now, because we're taking care of it. It's all this back and forth banter. It's all of this intentionally designed to prevent people from actually knowing what's going on. Don't worry, we got it. Look, let's be honest about this. The Federal Reserve is controlling this system very, very carefully. There was this nonsense, what was it, last year or the year before, where we were hearing about how, oh yeah, the Treasury is taking over the Federal Reserve, and they're going to become all one, and this is going to be the new thing. There's going to be a gold standard tomorrow, and this and that. Nothing has changed. The Federal Reserve rules, and that is truly unfortunate, let me tell you. But anyway, this is just a little bit that I wanted to mention about this. There's more information below. Reuters also covered the same issue. BlackRock, others, risk should be studied. Systemic tag may not be the best, according to Yellen. It's important to look carefully at systemic risks posed by asset managers, including BlackRock, but said designating them as systemically important financial institutions may not be the right approach. Of course, the way that they've set this up right now today makes sure that we have all of these different companies put under a certain level of scrutiny. But if we want to increase that scrutiny on them, that's just going to be unnecessary. So let's not do that. There's never enough scrutiny on these financial institutions who are able to take literally nothing in some cases and create an asset out of it and multiply it many, many times forward. It is a complete lie that they tell you. And of course, why? Because it's a revolving door. That's the way this system works. We have to start realizing that is the absolute fact of what we're dealing with. BlackRock is joined at the hip to the US government right now. They're making all of these purchases for them. They're monetizing the debt, working in a way with the Federal Reserve. It's all one in the same. Please, we need to stress that information. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for doing that. I appreciate all of those who support me in any way, shape, or form. Thank you so much. If you want to learn about e-commerce, you're interested in selling stuff online, you can do so for free at my website, theamazongps.com. If you want to understand the financial system from top to bottom, A to Z, you can get all of that in which you need in these 2 books. Check them out at the link in the description. If you want to check out this video, there's a lot of great detail in here. If you haven't seen it already, click it and I'll see you there.